Trend strength and continuation signals are important concepts in technical analysis because they help traders understand whether an existing market trend is likely to remain active or whether its momentum may be weakening. A trend represents the general direction of price movement and can be bullish, bearish, or sideways, while trend strength describes how consistently and forcefully price is moving in that direction. Identifying a strong trend can help traders avoid entering against momentum and instead look for opportunities that align with the prevailing market direction. In an uptrend, price typically forms higher highs and higher lows, while a downtrend generally produces lower highs and lower lows. When these structures remain intact, the trend may have a greater probability of continuing. Traders can use several technical tools to evaluate trend strength, including moving averages, trend lines, trading volume, momentum indicators, and price action. A rising moving average with price consistently trading above it can support a bullish trend interpretation, while a declining moving average with price remaining below it may indicate bearish conditions. The slope of the moving average can also provide useful information because a sharply rising or falling average may reflect stronger directional momentum, whereas a flat moving average can suggest consolidation or a lack of clear direction. Trend lines can provide another way to evaluate market structure. When price repeatedly respects an ascending trend line during an uptrend or a descending trend line during a downtrend, the trend may still be intact. However, traders should avoid assuming that every trend line touch will result in a continuation because markets can break established structures unexpectedly. Continuation signals are especially useful after a temporary pullback or consolidation because they can indicate that the dominant trend may be preparing to resume. Common continuation formations include flags, pennants, triangles, and channels. For example, during a strong uptrend, price may temporarily move sideways or slightly downward before breaking above the consolidation area, potentially signaling renewed bullish momentum. Similarly, during a downtrend, a brief upward correction followed by a break below support may indicate that sellers are regaining control. Candlestick patterns can also provide continuation clues when they appear in the direction of the broader trend. A bullish rejection candle near support during an uptrend or a bearish rejection candle near resistance during a downtrend may provide additional evidence that the trend remains active. Trading volume can further strengthen continuation analysis when a breakout occurs with increased participation, although volume should be interpreted according to the specific market being traded. Traders should also distinguish between genuine continuation signals and false breakouts. A price move beyond a trend line or consolidation boundary does not always lead to sustained movement, so waiting for a candle close, retest, or additional confirmation can help reduce the risk of entering too early. Multiple timeframe analysis can also improve trend assessment by showing whether a short-term continuation setup agrees with a broader market direction. Most importantly, trend strength should never be judged using a single indicator. Combining market structure with moving averages, support and resistance, price action, momentum, and volume can provide a more balanced assessment. Risk management remains essential because even strong trends can reverse unexpectedly due to changing market conditions. Overall, understanding trend strength and continuation signals allows traders to focus on the probability of an existing trend continuing rather than constantly trying to predict reversals. By recognizing healthy market structure, identifying controlled pullbacks, waiting for confirmation, and managing risk appropriately, traders can develop a more disciplined approach to trend following and technical analysis.